Today was a green day, and my puts did sell on stop losses. I'm optimistic, but there are still a few things to look for. Let me explain. It's a beautiful thing to see. A flag, a run up, and a flag formed. Yesterday, we saw a lot of resistance at the $31.22 and $31.68 levels, and you can see those highlighted by these kind of magenta circles here. And today we also had a rejection there. When the price rose above the December 2nd high, that $31.22 level, this was when I started to think about selling my puts. As the price continued to rise and surpassed $31.68, that was the cue. That was the moment I knew we were going to see a run. And the big giveaway was the implied volatility right here. I'm going to highlight it with a little rectangle. Okay, you can see that the implied volatility begins to increase with the price. Typically, what we see is the price declining alongside the implied volatility, as you can see here. As the flag forms and the price descends, the implied volatility gradually decreases as well. To see that inversion where the implied volatility is working in favor of the price, specifically the bulls, is very, very good. I've been looking for that. However, we don't yet see that on the daily scale. Let me go out to the daily chart really quick and show that. As you can see on the daily chart, I have the implied volatility here on the bottom, and there is a line here. And this is something I was wanting to show, that the IV had room to move down, and that would happen if the price were to rise. And that's what we saw today. We saw the implied volatility drop as the price moved up. We have 3 green candles, and these look very bullish, do they not? And the implied volatility is dropping. You'll see in cyan a rising wedge. And this is why I'm somewhat only cautiously optimistic, because truthfully, this could be a bull trap. I'm gonna zoom into the 15-minute time scale and give you a better idea of what that rising wedge would look like. Here's the 15-minute chart, and as you can see, that rising wedge terminates nearly exactly at the ascending triangle target of $35.64. Interesting, isn't it? The rising wedge is generally a bearish pattern, and to see one form now is somewhat ominous. If this does break down, I wouldn't expect to see a fall beyond the symmetrical triangle target of $29.04. However, if this does play out bearishly, the measured move down is back on the table. I've now pulled up my 15-minute chart drawings over the 15-minute chart, and what you can see is a descending broadening formation in yellow. And there are 2 price targets for that broadening descending formation. The lower end is at $20.36. The higher end is at $35.06. And these red lines, they show the retracement levels for the move down from $45 to the more recent low at $25.31. These levels are important because they play into the measured move down. The measured move down is looking for a retracement to that 70% level. And yesterday we struggled to get above that exact spot. And let me just put another little oval down where that was. This oval shows a lot of resistance at that specific level. Now, the level above it is a Fibonacci retracement level, the 61.8%. And it is possible that this level acted as resistance and it could have killed the momentum from the run-up we saw today. Whether or not the price moves above that 61.8% retracement level will be our bearish or our bullish cue. This still can be bearish. I know that we've had 3 really good days after a big drop, but honestly, this hasn't been the enthusiastic bounce back that I've wanted to see. Going into tomorrow, should we see the 61.8% level broken, I fully anticipate that the price will move higher and reach that $35.06 price target and then some due to momentum. If the price breaks down below this 70% retracement level at $31.50, then that would be exceedingly bearish. And I really think that the monthly VWAP there might turn against us. This is my 4-hour chart with my 4-hour chart drawings. What we see is a descending channel in yellow. Recently, we tested that bottom channel and bounced, and we are now approaching the top of that channel. Reaching the top of this channel would bring us to about the $34.50 to $35 range, which is very, very close to that descending broadening formation price target. Whether or not the price can move above this level is going to be a very big deal. In the past, we did see the price move above here, find resistance, and then ultimately fail. Re-entering this channel was exceedingly bearish, and we could see a continuation within this channel. First, we need to see a breakdown after the price reaches 35 to confirm that. This is why I'm watching the $35 level so closely. Yes, it's very good to see these big moves up, but this has been a devastating blow done to the charts on a technical basis. It is still very possible that the measured move down will play out. And if anything, this downward channel supports that. I would assume that if the price does reach $34.50 to $35 and then rejects, this downward channel will provide support again in the low 20s, which is near the lower price target for the descending broadening formation. There's a lot of different things going on right now in terms of chart patterns and the analysis, but they're all mostly aligning. If $35 is surpassed, then the recovery and a bull run is on its way. A rejection at that level is very bearish. So I am optimistic, very cautiously so. And I do want to announce that I've updated or upgraded my account to a margin account. What this means is that I'm going to have far more funds to trade with, and this will enable me to put together complete and full options trades. And I'm really excited about that. What I've been showing so far have been pretty bad trades, and the reason for that is I simply don't have the capital to put what I would call a complete trade together. I like to trade options in sets of 4, but when you can only afford 1 or 2 options, it becomes exceedingly difficult to make an adequate, smart, and well-educated play. So moving into the future, I'm going to be sharing what these trades are and how that plays into my analysis. It's going to be really big stuff, it's going to be a little more technical, but I am really excited. And I'm also thinking about making a series of videos explaining technical indicators. Short videos, 1 to 2 minutes, explaining VWAP, implied volatility, MACD, simple things. Things that I take for granted to know, actually. They aren't really simple, but I want to end today's video back on the 1-minute chart. This is a flag, and I am very excited because should we see this flag play out, we could see the realization of the upper descending broadening formation price target. So this would be our flagpole that I just drew in cyan. And should the price break out tomorrow morning, a full extension of the run could be seen, and that would put us up above $36. Now, Bukowski does have some measure rule options here. He says there are 4 combinations of the measure rule computation. You either take the full height of the flag and apply it to the breakout price, or you take the full height of the flag and you multiply that value by the percentage being price target, which is 46%. In this instance, that would be about $2. Closing today at 32, you add $2 when you get 34.35, throw some momentum in when you get 35.